Welcome back, everyone. Today we're conducting a complete, unbiased forensic audit of AMC Entertainment. We're putting all the emotion aside and looking strictly at the hard data. We're going to match our actual predictions from last week against real-time market action to see if our technical launchpad held or if the bears were right all along. But more importantly, we're going to answer the big question. Has AMC actually transformed from a speculative meme stock into a genuine cash-generating machine? And could a $4 price target really be on the table? Let's get into it. If you want more deep dive breakdowns exactly like this one, do me a quick favor and hit that subscribe button right now. It genuinely helps the channel grow. Alright, let's continue. To understand how all these pieces fit together, let's zoom out and look at the core engine of this entire thesis. When you analyze a highly debated stock like AMC, you have to look at it through three distinct, objective lenses: the technical foundation, the fundamental engine, and the tactical playbook. Technically, we're tracking a highly disciplined staircase trend of higher lows, consolidating perfectly within our predicted support. Fundamentally, this business is undergoing an absolute operational renaissance, generating record revenue, restructuring its balance sheet, and trading at a deep discount to fair value. And tactically, we've got a clear binary playbook for short-term swing traders looking to lock in fast profits and long-term accumulators targeting a massive compounding upside. But while these numbers look incredibly solid on paper, there's one hidden options metric we'll get to in a moment that completely changed this week's price action. And once you see it, the whole picture snaps into focus. Before we get into that options trap, we have to look at the scoreboard and see how our predictions from last week actually stacked up against reality. If you watched our last video, you know we laid down a highly disciplined technical framework for this week, so let's grade ourselves honestly. First, we predicted that the 235 to 250 range, which used to be a massive wall of overhead resistance, would flip and become a rock-solid floor of support. That was a perfect alignment. The stock tested this support daily and flat-out refused to break below it. Second, we warned swing traders to scale out and lock in their profits inside the $2.75 to $3 resistance zone. That was also a perfect call, because heavy selling pressure capped the weekly high at 264, which kept our audience from buying the top. However, our third call, the highly anticipated $3 plus gamma squeeze, did not ignite. Instead, it transitioned into a healthy consolidation. So the obvious question is, why did the fuse fail to light on that explosive breakout? Was it a warning sign or something far more bullish? But that's only half the story. If we look closely at the daily trade logs, we see an incredibly bullish technical defense. Despite heavy industry-wide profit-taking, the staircase trend of higher lows stayed completely intact. That 235 to 250 support range acted like a massive magnet for buyers. On Monday, the stock bottomed at 239. On Tuesday and Wednesday, it hit a low of exactly 238 before aggressively repelling the bears. By Thursday, it consolidated and rallied to close at 263, then finished the week testing the top of our support range right at 250. And this tells us something huge. The market has officially accepted this range as the new baseline. The previous ceiling has successfully flipped into a launchpad, establishing a solid foundation for the next upward leg. Think about that for a second. What was once resistance is now the floor. If we dig deeper into the actual numbers, we can see exactly why the $3 breakout coiled instead of exploding. It comes down to two mechanical factors: volume and the options chain. In our last video, we noted an options concentration of 43,000 open contracts at the 250 strike and 89,000 at the $3 strike. But here's the twist. The actual options chain for the August 14th expiry revealed a major disconnect. There were only 4,700 contracts of open interest at 250 and just 7,400 at $3. That's an over 90% deviation from our forecast. Combine that with light trading volume, which averaged between 12 and 21 million shares versus our 38.6 million average, and market makers had zero mechanical need to aggressively buy shares to hedge their positions. But here's why this isn't a failure at all. It's a healthy shakeout of weak hands, coiling the spring even tighter. So ask yourself, what happens when that spring finally gets its fuel? But none of this technical coiling matters if the business behind the stock is hollow, which brings us to the jaw-dropping turnaround in the core business. Let's talk fundamentals, because what's happening operationally is absolutely spectacular. AMC is no longer a speculative meme stock. It has become a cash-generating engine. In the second quarter of 26, AMC shattered its all-time records. Powered by the blockbuster debuts of Christopher Nolan's The Odyssey and Spider-Man Brand New Day, the company welcomed over 10.2 million moviegoers in a single weekend. That one weekend generated an estimated provisional run rate of $206 to $228 million, which means AMC captured up to 14% of its entire quarterly revenue in just 5 days. Let that sink in. This pushed second quarter revenue to $1.597 billion, representing a 14.2% year-over-year surge, while adjusted EBITDA skyrocketed 69.6% to $321.4 million. And the way AMC converts this massive revenue into pure profit is where the real financial leverage happens. This is the concept of operating leverage, and it is the single most important metric for any long-term investor in this space. Here's why. A theater operator has massive fixed costs, like rent, utilities, and staff. But once those baseline costs are paid, almost every incremental dollar of revenue flows straight to the bottom line. And in the second quarter of 26, AMC converted an unbelievable 66 cents of every single new dollar of ticket and concession sales directly into operating profit. That explosive profitability expanded their adjusted EBITDA margins to a stellar 20.1%, helped the company generate a massive $190.1 million in free cash flow, and pushed their trailing 12-month revenue close to $5.5 billion, an all-time historical record for the company. So the real question is, if the business is printing cash like this, why is the stock still being treated like it's on life support? Well, with this level of cash generation, the single biggest bear thesis in the history of this stock has officially been crushed. The absolute centerpiece of the short thesis was always bankruptcy. The bears argued that AMC's massive pandemic-era debt load would inevitably lead to default. Well, that narrative is officially dead. On the back of these record cash flows, Standard & Poor's officially upgraded AMC's credit rating to B-. The company has aggressively eliminated one-third of its over $6 billion in pandemic debt, bringing its remaining principal debt down to $3.914 billion. And it gets better. Their cash reserves climbed 81.7% in the first half of the year, up to $778.4 million. Through what can only be described as masterclass treasury management, AMC refinanced $400 million due in 27 and successfully pushed its major maturities all the way out to 29 and 31, clearing a multi-year operational runway with zero immediate repayment pressure. So if the bankruptcy story is dead, what exactly is holding this stock back? So what is all of this actually worth? The market is currently suffering from a massive valuation disconnect. If you calculate AMC's true intrinsic value using a conservative discounted cash flow model from Simply Wall Street, the stock's fair value comes out to $3.51 per share. But trading at around $2.51, the stock is sitting at a massive 28.5% discount to its fair value. And the relative valuation is even more absurd. AMC is currently trading at a forward 12-month price-to-sales multiple of just 0.42 times. Now compare that to the broader entertainment industry average of 1.3 times. The market is pricing the leading premium theater operator in the entire world at a tiny fraction of its peers, even as its operational recovery paces well ahead of pre-pandemic levels. Does that sound like a fair price to you? Or does it sound like an opportunity hiding in plain sight? And guess what? Institutional Wall Street is finally waking up to this discrepancy, and they are scrambling to catch up. For years, institutional analysts maintained ultra-bearish targets, but just look at this shift. Wedbush has maintained an outperform rating with a $4 price target, pointing to AMC's dominant premium screen leadership, including 225 IMAX and 181 Dolby screens. Benchmark and Texas Capital have both upgraded the stock to a buy with a $3 price target. Zacks Investment Research has upgraded AMC to a Zacks rank number 1, which is a strong buy. Even Citi was forced to lift its price target by 50%. And here's the kicker. The smart money is quietly loading up before the retail crowd even catches on. In the second quarter, BlackRock added a massive 16.2 million shares, increasing their position by 40.4%, while Nuveen increased its stake by a staggering 486%, adding 7.8 million shares. When the biggest institutions on Earth start moving this fast, you have to wonder what they see that everyone else is missing. But these backward-looking upgrades don't even account for the massive pipeline of upcoming structural wins. The future pipeline is absolutely loaded with structural game changers that could guarantee long-term operational success. First, in a historic pivot, Netflix is leaning heavily into theatrical releases. Greta Gerwig's highly anticipated Narnia, The Magician's Nephew, will debut in exclusive IMAX previews on February 10, 2027, establishing a historic 49-day exclusive theatrical window before it ever hits streaming. That is an unbelievable structural win for theater operators. Second, the Paramount Skydance acquisition of Warner Bros. Discovery pledges a minimum of 30 theatrical films annually with a strict 45-day theatrical exclusivity window. And third, AMC is expanding Arena One, bringing live interactive concerts to over 300 theaters under a highly profitable revenue-sharing model that requires virtually zero upfront capital expenditure. So imagine all of that momentum landing at once. What do you think that does to a stock this deeply discounted? Those fundamental catalysts are the exact fuel needed to trigger a mechanical technical phenomenon. Now, let's talk about the squeeze potential, because the mainstream media is completely looking in the wrong direction. They're focusing entirely on the traditional short interest, which sits at a modest 5.23% of the float. But what they're completely missing is the gamma trap. Implied volatility for AMC options is surging. That extreme concentration of open interest at the $2.50 and $3 strikes represents a tightly coiled spring. And because of this high volatility, the moment a fundamental box office catalyst triggers a sudden surge in buying volume, institutional market makers will be forced to aggressively buy shares on the open market to back those options. That mechanical delta hedging can spark a violent, self-reinforcing upward spiral, completely independent of traditional short sellers. It is, quite literally, a mathematical trap just waiting to be sprung. So what happens the day that trap finally goes off? Now, none of this matters if we don't look at the risks. On September 24th, AMC is hosting its annual meeting, and the proxy statement features some incredible corporate developments. Proposals 1, 3, and 4 are massive stockholder-friendly governance wins, moving to declassify the board so all 10 directors stand for annual election, eliminating written consent restrictions and allowing stockholders to call special meetings. But the real masterstroke here is Proposal 5, doubling the equity incentive plan to 50 million shares. Now the media will scream dilution, but the board's filings reveal the brilliant reality. Without these shares, AMC would be forced to settle executive equity awards in pure cash, draining $17.1 to $58.6 million of precious liquidity. By approving Proposal 5, the company preserves that cash, which allows AMC to maintain its operational momentum and pay down debt even faster. So the thing the headlines call a red flag might actually be one of the smartest moves on the table. So, with all these elements aligned, how do we actually play this chart to maximize our gains? Here is your exact tactical playbook. If you're a short-term swing trader, your move is to buy the consolidation. Look to build or add to your positions inside that validated 235 to 250 support floor, and raise your trailing stop losses to just below 235 to fully lock in your gains. Then, when the stock rallies, don't let greed take over. Scale out of 80% of your position inside the $2.75 to $3 resistance zone, but leave a small runner active to capture the explosive potential of a $4 breakout. Now, if you're a long-term strategic shareholder, your job is to block out the noise and accumulate. View any healthy pullback into the $2 to $2.12 technical floor as a golden, high-conviction accumulation zone to build your position for the multi-year EBITDA compounding. When you look at the big picture, the technical and fundamental paths are converging on one undeniable conclusion, and this is the ultimate payoff. On one side, we have an immovable technical support floor at 235 to 250, backed by surging implied volatility. On the other side, we have record-breaking operational EBITDA, a clear debt maturity runway, and aggressive institutional upgrades. These two forces are converging directly on our $3.51 intrinsic value and our $4 breakout target. The bankruptcy risk is dead, the operational engine is roaring, and the technical spring is coiled. Now, before we wrap up, I need to be crystal clear with you. Everything in this video is for educational and informational purposes only, and it is absolutely not financial advice. I am not a licensed financial advisor, and nothing I've shared here is a recommendation to buy or sell any security. The stock market carries real risk, and you can lose money. So please always do your own research and consult a qualified financial professional before making any investment decision. With that said, here's the bottom line. Do not buy the top in a panic. Instead, accumulate during this healthy consolidation and prepare for the structural breakout. So now I want to hear from you. If AMC really is the calm before a massive breakout, what's the one catalyst you think finally sets it off, and where's your personal price target? Drop it in the comments below, because I read every single one, And if you found this forensic audit valuable, do me a favor and smash that like button and hit subscribe so you never miss a breakdown like this. I'll see you in the next video.